Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll continue with Accounting Chapter 5, that is Concept and Accounting of Depreciation. This is lecture number 9. Let us continue. In the previous lecture, we had completed with the sum of digits method. In this lecture, we'll begin with annuity method. Annuity method. This is a method of depreciation which also takes into account the element of interest. The element of interest on capital outlay and seeks to write off the value of asset as well as the interest lost over the life of the asset. It assumes that the amount laid out in acquiring asset if elsewhere interested would have earned some interest which must be reckoned as a part of the cost of the asset. On that basis, the amount of depreciation to be annually provided in the accounts is ascertained from the annuity tables. To write off each year interest on the capital outlay as well as the part of the capital sum at a rate that the whole of the capital sum and the interest accruing thereon would be written off over the life of the asset. Though the amount written off annually is constant, the interest in the earlier years being greater, only small amount of the capital outlay is written off. This proportion is reversed with the passage of time. This method is eminently suitable for writing off the amounts paid for long leases which involve a considerable capital outlay. It is not practicable to adopt this method for writing off depreciation for plant and machinery on account of frequent changes in the value of such assets, which would necessitate the recalculation of amount of depreciation to be written off annually. I believe you understood till here. I believe you understood. Just write few things over here. Cost of assets. Cost of assets should be invested somewhere, should be invested somewhere which would have which would have given given interest. Next, amount of depreciation, amount of depreciation, amount of depreciation would be higher, would be higher, covering covering both cost cost of asset and interest rate lost. Interest lost. We can say that depreciation equals cost of asset divided by PVAF R percentage time. PVAF R percentage time. R percentage is rate of interest, is rate of interest. T over here is life of asset, life of asset, and is PVAF is present value annuity factor. Present value annuity factor, that is PVAF. That is PVAF. I believe you understood till here. Let us see how we will journalize these transactions. Relevant journal entries are A. First, for charging interest on asset account debit to interest account. Asset account debit to interest account. Second, for charging depreciation on asset. For charging depreciation on asset, depreciation account debit to asset account or provision for depreciation account. Depreciation account debit to asset account or provision for depreciation account. Third, for transferring depreciation to profit and loss account, profit and loss account debit to depreciation account. We have transferred the depreciation to profit and loss account over here. Fourth, for transferring interest to profit and loss account. For transferring this interest to profit and loss account, so interest account will be debited and profit and loss account will be credited. I believe it is clear. I believe it is clear. Let us learn few things about PVAF. Let us learn few things about PVAF. Present value annuity factor. Supposingly, the present value annuity factor is 8% for 7 years. So PVAF 8% 7 years is present value annuity factor at the rate 8% for 7 years. This means this. Supposingly it is PVAF under bracket 10% 3 years. This means what? Present value annuity factor at the rate 10% for 3 years. 10% for 3 years. It would be written like this: 100 upon 110. 100 upon 110 to the power years. To the power years. Cost of the asset divided by PVAF are percentage and time. Let's try to find this. Let's try to find this. So it would be 100. So it is 100, basically 100 plus R. R is 10%. So 100 divided by 110 over power to the power 3. This is power 1. So 100, do it on your calculator. 100 divided by 110. 100 divided by 110, do it on your calculators. Type 100 divided by 110 equals 0.909 equals 0.909 Now just do into equal to, you'll get for the second year 0.826. This is for the second year 0.826. For third year, just click equal to, just press equal to. It is 0.751. It is 0.751. Now we need to total it. Just press GT. Just press GT. 2.4868 must be flashing on your screen. Do it once more using your calculator. 100 divided by 110 equals 0.909 into equal to 0.826 must be flashing. Now press equal to 0.751 for the third year. The total is 2.4868. Press GT. Press GT. 2.4868 must be there on your calculator screen. Is it fine with you? I believe it is fine with you. You must have done it. You must have done it. Okay. Let us continue. Let us continue. Right example. Right example. Cost of asset. Cost of asset equals 3 lakh. Estimated life. Estimated life equals 5 years. Rate of interest. Rate of interest equals 8%. Calculate depreciation by annuity method. By annuity method. I believe it is clear. Calculate depreciation by annuity method. I believe it is clear. Depreciation. Calculate depreciation equal to cost of asset divided by PVAF, R percentage and time. Cost of asset equal to divided by PVAF, R percentage, time. Over here the cost of asset is 3 lakh. The cost of asset is 3 lakh. PVAF rate percentage is 8% and time is 5 years. Time is 5 years. So 3 lakh divided by, we have to calculate it on using a calculator. So do it on your calculators. How you'll do it on your calculator? So it is 8%. So 100 plus 8 is 108. Type 100 divided by 108 equal to. Type on your calculator 100 divide by 108 equal to. So this is first year 0.925. Now for the second year press into equal to. For second year press into equal to. We have to go for 5 years. Now press 3 times equal to for third time, equal to for fourth year, equal to for fifth year. I believe you understood. Now present value annuity factor, make a total of it. So press GT. Press GT. Press GT. What figure we got over here is 3.99271. What figure we got over here is 3.99271. So 3 lakh divided by 3.99271, solve on your calculators. It is 75137. It is 75137. So this is the value of depreciation. This is the amount of depreciation. Kindly write steps to solve on calculator. Steps to solve on calculator. Steps to solve on calculator. 100 by 108 equal to, this is step 1. Then press into equal to step 2. Then equal to step 3. Equal to step 4. Equal to step 5. And the figure you'll get is 3.99275. This is step 1. 100 by 108 equal to. Now multiply equal to step 2, step 3 equal to step 4 equal to step 5 equal to. I believe you understood till here. I believe you understood this example. Write one more example now. Example. Example. Cost of asset. Cost of asset 4 lakh. Estimated life. Estimated life 6 years. Estimated life 6 years. Rate is given, which is 9.5%. Rate is given, which is 9.5%. Calculate. Calculate depreciation. Calculate depreciation by annuity. By annuity method. Calculate depreciation by annuity method. Okay, let's try to solve it. Solution. Solution. Let's try to solve it. Solution. Right. Depreciation equal to cost of asset. Cost of asset divide by PVAF R percentage T. Divide by PVAF R percentage T. Over here in this question, the cost of asset given, that is 4 lakhs. PVAF, the rate is 9.5% and the time is 6 years. And the time is 6 years. Calculate it using your calculators. So it would be 4 lakh. 4 lakh divided by PVAF 9.5% 6 years. Do it along with me on your calculator. Type 100 divided by 109.5. Type 100 divided by 109.5 equal to on your calculator. On your calculator, type 100 divided by 109.5 equal to. Now type into equal to. Type into equal to. Now press 4 times equal to, equal to, equal to, equal to, equal to, and then press GT. And then press GT. What we receive over here is 4.4198. 4.4198. 98. 4.4198. Tries to solve it. 4 lakh divided by 4.4198. 4 lakh divided by 4.4198 equal to 90502. Equal to 90502. 90502. Right over here, steps to solve on calculator. On calculator. Step 1, 100 divided by 109.5 equal to step 2 into equal to step 3 equal to step 4 equal to step 5 equal to step 6 equal to, and then press GT. Then press GT. What you'll get is 4.4198. What you'll get is 4.4198. PVAF is 4.4198. I believe it is clear. Let us continue. Let us continue right over here. Right over here. Under annuity method. Under annuity method. Such an amount is charged is charged by way of depreciation which takes into account not only the cost of the asset but also interest thereon at a given rate at a given rate. Next, write features of annuity method. Features of annuity method. First, it takes into account the interest on the amount invested in the purchase of invested in the purchase of asset. Number two, interest is provided each year Interest is provided each year on the opening balance on the opening balance on the opening balance of the asset on the opening balance of the asset account and goes on decreasing goes on decreasing year after year after year. Third, a fixed amount a fixed amount of depreciation a fixed amount of depreciation is charged each year. The amount of depreciation the amount of depreciation is computed with the help of with the help of annuity table with the help of annuity table as follows as follows fixed amount of depreciation fixed amount of depreciation original cost original cost less scrap value less scrap value multiplied by value of annuity value of annuity for a given period for a given period at a given rate of interest at a given rate of interest plus 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 interest on scrap value interest on scrap value for a year interest on scrap value for a year at a given rate of interest at a given rate of interest. I believe you understood till here. I believe it is clear till here. Let us go to point number 4. Effect on profit and loss account. Effect on profit and loss account. The net charge to the net charge to profit and loss account increases year after year increases year after year, even though the depreciation is fixed sum. This is because this is because of interest. This is because of interest amount decreases decreases year after year. However, however, the however, the total net charge to profit and loss account is is equal equal to the cost of lease is equal to the cost of lease. Let us move ahead. Right. Next point, that is merit of annuity method. Merit of annuity method. This method this method takes into account takes into account the the interest the interest on the amount invested in the purchases of an asset. I believe you understood. Let us continue. Write demerit of annuity method. Write demerit of annuity method. When additions are made to the asset when additions are made to the asset, fresh computation fresh computation fresh computation have to be made fresh computation have to be made, and the calculation becomes difficult calculation becomes difficult. This method increases the book value. This method increases the book value of assets, book value of asset, particularly particularly in the initial years particularly in the initial years, particularly in the initial years. Next, suitability, suitability of annuity method, suitability of annuity method. This method, this method is suitable for leases, leases in respect of which, in respect of which a lump sum payment is made, a lump sum payment is made in advance, in advance, in advance. Let us see what we have done in today's class. Let us see what we have done in today's class. So we have begun with annuity method. We have begun with annuity method. We noted down the formula to calculate the annuity method depreciation, that is cost of the asset, divided by PVAF, rate percentage, and time, that is life of the asset. PVAF denotes over here present value annuity factor. We have seen the accounting treatment. We have seen the accounting treatment of depreciation using annuity method. Then we have seen how to calculate PVAF on calculator. This is significant. Then we have done several examples in relation to calculation of depreciation by annuity method. The formula to calculate the depreciation would be same. Steps to calculate on calculator is important. We have seen another examples. A bit long steps was there because this is of 6 years of case. The expected life of the asset is 6 years in this case. Then we have written the meaning of annuity method, the features of annuity method. We have seen the features in detail, and then we have recorded the merits of annuity method, demerits of annuity method, and in which cases the annuity method will be suitable. So the answer is in the leasing cases, in the lease cases, this method is suitable. I believe you are clear till here. I believe you are clear till here. Fine. So we are stopping here. We are stopping here. We'll continue from here in the next class. Thank you.